Okay, so we're going to talk about advanced Bollinger Bands and Fibonacci, two tools that I use in all my charting techniques, and most of my algorithms, etc., etc. I think Bollinger Bands, uh, Bollinger Bands work, because they are based on a moving average. A Bollinger Band is not actually that complex. It's actually two standard deviations around a moving average. So it is one of the most simple forms of technical analysis that you can display on your charts. And Fibonacci is great because Fibonacci works with what's happened in the past, what you actually know, so you can predict what's going to happen in the future by basing things on past movement. And Fibonacci, again, is something I've used, the majority of my trading career. So before I start, as always, the risk warning. Remember that spread betting and safety trading can have high leverage your capital, resulting in losses that exceed your initial deposit. It may not be suitable for everyone, so please ensure you fully understand the risks involved. Now, the information comments provided here in no circumstances are not a solicitation to invest. Nothing herein should be construed investment advice. The information provided is accurate. The data is produced. Education only. The content of the webinar is personal opinion of the moderator, not Intraday.com. The content does not constitute financial investment or tax advice. Intraday.com does not set out liability for the content content during this session. I guess there's a few popular misconceptions about trading, and it's professional traders always make money. The market's controlled and manipulated. You have to hold positions for long periods of time to make money. Trading's a good way to get rich quick, and everyone reads the charts the same. Now, I guess trading's the same for everybody. 99% of the time, we've got access to the same information, and that is where the real crux of trading lies. That we all see the same information. We all have access to the same information. We're all in the same market conditions. However, trading is different for everybody. Things do not always present themselves in the same way. Very much like, I don't know, playing golf. You can be, great at driving, not so good at the irons, but, you're a good putter. We can all get to a level of par. We can all get to, play a good game of golf, but we do it in our own specific ways. And that is just the same in the markets. Making money is a way of keeping score, but how we get those is very, very different. Why is it so difficult to make money in trading? I guess it becomes difficult because of the fact that there's just so much. There's so much information. There's so much going on, and that there is no set way to make money. There's no one guaranteed way of making money in the markets that I've seen. It just doesn't exist, and that's what makes trading so difficult. Is that we can all be involved in the markets. We can all understand what a trend is. We can all understand what information is, but the ability to make money, is pretty difficult sometimes. And I guess there's no real mystery about trading. You buy low, you sell high. It's quite a simple concept. But the reason there's so many people involved in it, there's so much. When we talk about so much money, there's $3, 4, 5 trillion traded in the FX markets alone. Think about the types of people involved in trading. Not just currencies but indices, oil, commodities. It's so complex, and the reason that it is complex is because of the amount of money that's involved, the amount of people that's involved, and I think the reason I think a lot of traders find it difficult is that both the fundamental and technicals will drive the markets, but you can never be exactly sure, when these ratios hit, and I guess not even two trades are the same. You can buy on some news, you can sell on some news, and then the next time you trade this bit of information, it acts in a different way. And I guess the first step for me in a successful trader is understanding yourself and how you act. I can't teach you how to trade like me because you're not me, and that's the whole point. A lot of people read the books, read things on the internet, listen to my webinars and other sources of education because they're trying to figure out how other successful traders act and then try and copy that. And that isn't really what trading is all about. Trading is all about understanding yourself, figuring out how you interact with the markets, and coming up with your own formula, your own strategy. And that's how you become successful, by doing something that you can repeat and something that works for you. Okay? And when we talk about things like Bollinger Bands and Fibonacci, of all the kind of studies that I've used over the years, these are certainly not the easiest, but they give you the most. I mean, they give you the most kind of. It's not easy. That's not the right word. They give you the best point of reference of something you can put together and use again and again. So, again, the whole point about being a good trader is being, consistent and being, consistent in the markets. And I think Bollinger Bands are a good reference point to start with because they are a fairly simplistic idea of working around the moving average, and then you can coincide that with something like Fibonacci that understands if a strong directional move that coincides with the Bollinger Bands has gone from the highs to lows, then there's going to be certain points in which the market will come back to. So really, if you're trying to figure out what your strategy is, with technical analysis, you can literally have limitless, strategies because there is so much to use out there. But I would say that if you start with the basics and things like Bollinger Bands and Fibonacci, it's a good starting point. We can build other things onto it. So my strategies have come from just years in the markets, years and years and years in the markets. If there's a way to not to trade, I've certainly found that. I've tried like everybody else. I've invested colossal amounts of money in trying to find out, ways to beat the markets. And a lot of the time I was kind of a counter trend trader. I've got lots and lots of algorithms. Literally hundreds and hundreds and hundreds of thousands of pounds. I've got into research development trying to find a way to consistently make money, and it all comes down to that it doesn't exist, and that's as simple as that. There might be the odd grey black box out there that does work, and I know these kind of things do exist, but there's literally a handful of them. And if you're just an average person or a normal person, as I am, there's only so much money you can throw at these things. But before it just doesn't, you just have to kind of walk away. So really, for me, this kind of idea of letting a machine, letting a computer trade for you, and setting rules is it's a bit of, a great eye opener because there is no guaranteed way of making money. So what you have to do is turn on its head and find out how the most powerful computer in the world performs and what makes you tick and what rules you have to put together in order to trade the markets. And that really, ultimately, is what worked. So instead of looking for, a unique strategy, you start looking at what everybody else does and then just try to do it better. And that really, the fulfilling prophecy, the self-fulfilling nature of technical analysis, how humans behave, how the markets behave. Once you go back to those basics and start to understand that actually is a lot more powerful and gives you a lot more edge than trying to come up with something completely unique. Because the whole point of something that is completely unique to you, nobody else is doing it. So if you're the only person doing it, you have to have either an amazing strategy or a colossal amount of money to win over in the markets. If you're doing what the majority of the markets are doing, just a bit better, then you're going with the trend, you're going with the flow. And ultimately, that's a lot easier. So the four elements I use in my strategies, again, are RSI, moving averages, Bollinger Bands, hourly candlesticks. So again, what we're trying to figure out is what the market sentiment is, what the market is trying to achieve. And you can see that quite clearly when you look at RSI, Bollinger Bands, just even by looking at the candlesticks themselves, you can understand if a market, is aggressively buying up or selling down. So ultimately, what we're trying to do is figure out where the areas of support and resistance are, and do the basics well. Buy low and sell high. So if you're looking at a normal chart on something like MT4, then if you're just using the kind of standard parameters, it looks pretty bare, but it doesn't really make any difference. You can still see that this chart, whatever this product is, every time it gets to a low point, it goes up. So if you look at the same information, however, on the with the candlesticks, the Bollinger Bands and RSI, instantly you get a clearer picture, and this might be a buying market for sure. But when you look at the Bollinger Bands, the moving averages, everything's pointing it's going down. So that again is good. So you can understand that if you do want to buy low, you understand what low means. So by adding the four indicators that I've talked about, we can interpret charts much more objectively. And these things are they're not difficult to understand. I mean, firstly, we have the moving average. So a 14-period moving average is just that. It's back to maths that you did at school over 14 periods. This red line shows you the average price. Okay, so when we're below it, the market goes down. When we're above it, the market goes up. Pretty simple. The RSI, a very simple oscillator, which we understand. I mean, oscillator has a scale, whereas the moving average and the Bollinger Bands are indicators. Okay, the RSI is an indicator, but it's an oscillator because it has a scale between 0 and 100. So 50, the midpoint, yep, overbought at 70, oversold at 30. So we can see that, again, the RSI is above 50, but it's not yet to 70. So there is potential room for the market to go back up. Then we have the Bollinger Bands, which essentially are just 2 standard deviations around that moving average. Okay, so obviously this red line is a 14-period moving average. The Bollinger Band set to 20 period, so a slight change in that line. Then you've got support and resistance on the high and the low side. Then the candlesticks are showing tails, rejecting the sell side. So all these things are really kind of pointing to that this is a buying market overall. But as we're going down, you're trying to figure out a point in the market where we can buy back, and that is anywhere between 1 and 0.4, where the market is finding support on the moving average and the midpoint of the Bollinger Band. We're still looking positive in the RSI, and again, the market is, from the previous screen that we saw, is still overall buying, every low and going on to make new highs. So if we're looking at the charts this way, you're able to see that from a technical perspective, the pound versus the dollar is bullish on the hourly time frame. So we form an opinion, and that's relatively easy in that part of trading. If something's going to go up or something's going to go down, anybody that can look at a chart can figure that out. But as I've always said with trading, it's not about being right, it's about being right at the right time. We can all have an opinion and want to do something, but if you don't do it in the right way and at the right time, that's what actually can cost you money as a trader. I mean, how many times have you been right in the direction of a market and still lost money in a trade? If I had a pound for every time I'd done that, I would be an extremely rich man, because we can all figure out what a market should do, and the direction it should take, but it's figuring out when it's going to do it. The whole point about markets and the way they function is they bring fear and greed together. So what the market lets everybody know that they've got a fair chance of understanding the market's going to go up or down, but then the second you press a trade, the market generally goes against you. This is the fear element. It tries to make you believe that you're wrong and get you out of a trade, so therefore the people in the markets can make more money off this movement. I guess trading's always about probability. So the majority of the key indicators, are bullish. That means probably the markets will go up. It all goes back to that self-fulfilling nature of technical analysis. If everything points to a bullish market, then it's very hard to argue why a market wouldn't go up. But in my experience, the markets tend to function in a different way. What they do is they do the opposite of what you think is going to happen in the short term, and in the medium term, they do exactly what you think. So that's the whole point about being right at the right time. There's no point buying a market that ends up higher on the day if all you do is buy it and it goes down. I mean, this is, again, why I think Fibonacci works for me, because you can actually use Fibonacci on a previous high, low, or previous piece of data, and then it helps you understand how that movement will happen in the future. Then you get a more solid idea of what could happen and when it could happen. That's the key point, when it could happen. And again, I'll show you how that works. So for me, if you look at a particular move, I mean, this is why Fibonacci for me is, quite a powerful indicator, because you see the market's here. This is a strong directional move. The market has moved down, quite aggressively. It's moved from, the highs, hit the moving average, and it's made a distinctive high point here, distinctive low point here. So what I'm saying is that if the market's moved down, okay, once we come back inside the Bollinger Bands and we follow the RSI up, well, what's happened in the past will again happen in the future. So this 50% level here, what we're saying is that 80% of the time, a strong directional move will retrace to 50%. Yep. So what we're saying is that from this high, this low, 80% of the time, eventually a market will retrace to 50%, which is here. And that's what this market does. So what we're trying to figure out is when it's going to do it. And again, this is where your Bollinger Bands help you. The markets have made a new low here. We don't trade outside the Bollinger Bands here. So what you're trying to figure out is, we'll do a buy at the low point here, do buy at the 23.6, the 38.2. We know it's going to get to 50% eventually, but when do you get involved? And this again is where the Bollinger Bands and the kind of RSI will help you, because as we stay inside the Bollinger Bands, as the RSI moves up, market then finds support and makes its way back up to that 50%. So again, it's not about being right, it's about being right at the right time. So what you don't want to be doing really is kind of getting in too early. You could buying here and the market goes up, but then it comes back down. So you might get spooked out of a trade. But as the RSI gains in strength, as does the market, that's when we see that kind of momentum kick in. We eventually get back to that 50%. So it's all about figuring out what's happened in the past and using that to predict the future. And that's why the combination of Bollinger Bands and Fibonacci are good, because the Bollinger Bands show you where essentially support is. Again, once we made these lows, we don't trade outside the Bollinger Bands. But then the Fibonacci shows you how it's going to move back. It's going to move back, between these levels of support, and it really does act like a magnet. When we get back to the 50%, I mean that's again, I guess that's your trade done, but we can easily see the market go back to make some new highs. But it doesn't really make any difference, does it? What you've done is you've found a low point with the Bollinger Bands. You've got a target for levels of support and resistance, back to that 50%, and the RSI again is giving you that confidence to stay in the trade, because if it doesn't hit below, or it doesn't go lower, should go higher. So Fibonacci's been around for a long time. When we talk about Fibonacci, we're not talking about the numbers themselves. We're talking about Fibonacci retracements. Okay, so Fibonacci retracements is just a mathematical figure based on the numbers that says, something that goes from point A to point B will generally move in these particular, levels. And it's been around for a long time. It's been described in Indian mathematics, and then there's a Chinese philosopher that that did something with Fibonacci, and essentially, it's one of these things. It's about retracements. It's about numbers. It's the reason why your forearm is the same size as your foot. So if you put your foot against your forearm, they're the same size. It's all about principles of movement, and and it happens in nature, it happens in maths, and the markets are essentially a lot of numbers. So it's something that helps us rationalize a complicated process by a fairly simple set of rules. So for me, Fibonacci, again, it's not about the numbers, it's about the retracements. So my basic philosophy of using Fibonacci, and again, you can read this in my books, and etc. It's a big part of my book, and it just basically says that it's a self-fulfilling technical analysis tool. Okay, so once you've identified, and this is the whole point with Fibonacci, this is what you have to get into your own head. If you can identify a strong directional move or a significant move in the market 80% of the time, that move will retrace back to 50%. Okay, and this is the crucial part, the time element. It won't happen instantly, but it will happen. And why? Well, because the quicker a directional move, the more people are going to be wrong or caught offside in long or short positions. So that leads to overextended moves in the market. And then again, these peaks have to reverse because people have to get out, people have to take profit. So what goes up will come down. Okay, nothing ever goes up or down in a straight line indefinitely. So what we're trying to figure out is when the markets have moved, they've peaked, and that again is where tools like RSI and Bollinger Bands can show you them tops and bottoms of the market. So once you've picked the top of the bottom, then the rest is pretty simple. You put your Fibonacci retracement on, and then you can see how the market may act in the future. And I guess the time frames are important. I mean, what we're trying to do always is look at the higher time frames and pick what can happen in the future. So we've got a monthly, weekly, and daily level here. So we can see that what happened in the past on the monthly will have significance, on the weekly and the daily. So the highs and lows that are made previously will become support and resistance in the future. And that again, is where Fibonacci can be very important. You can take a Fibonacci for monthly and put it onto an hourly chart, a Fibonacci from a weekly, and put it on a daily chart, a daily and a minute chart. It doesn't really matter. The whole point of Fibonacci is it works if you pick the right sample of data, and also you understand that what's happened in the past can happen in the future, so making it relevant to your trading, in the here and now. So as you can see, we're taking the highs and lows from the monthly. Again, a lot of people say, well, where'd your Fibonacci's from? Well, I mean, again, you see the market is actually, found good levels of support and resistance here, but these are the highs and lows. These are the absolutes of the market. So that's where we take it from. And when you draw that kind of medium point, through the charts, you can see that on the daily, this is a significant point. The market is bullish, okay, in the monthly. On the weekly, bullish. So every time when we hit this level, we were down below it, a couple of times, but only for short periods, relatively short periods of time before going up. And that's the same on the dailies. We're buying higher and making the market move up. And that all really relates from what the market's done in the past. Okay? So that 50% Fibonacci has actually acted as, pretty strong support within the markets going forward. And that's what we're using, a previous area of interest from the monthly chart. And again, it works on the weeklies, the dailies, and it will work on the smaller time frames as well. So again, what we're trying to figure out is, where support is. So where does support come from? Well, support comes from previous levels, previous highs and lows. So you get much more idea on the monthly, weekly, and daily charts of where support can be than you will do on your smaller time frames. So by using things like Bollinger Bands and Fibonacci in the higher time frames, you can then let them filter through to your smaller time frame charts. So again, think about this. I mean, if you look on your monthly chart here, we're looking for, your red lines are monthly, your blue lines are weekly, and your kind of light blue lines are daily. So you get all the information you can from the monthly chart, and then you put them on your hourly chart, and you see what was, on your hourly chart. Well, there we go. A nice level of support that was once a weekly level. So as the market goes up and down, you're actually using your intraday charts with boundaries and with levels and lines that come from your higher time frame charts. And I guess all time frame trading, for intraday, this is how people trade. You look for your monthly, weekly, or daily Fibonacci's, okay, and you put them levels through to some meaning that you can trade from, so your hourly or 15-minute charts. And that can be the same as Bollinger Bands, RSI. What you're trying to figure out is when the markets are going to move in the direction you want, and when they're going to do it. And that all comes from previous data. So the whole point of Fibonacci Bollinger Bands is that yes, they're great for intraday trading and understanding short-term areas of interest, but all the real key data comes from the higher time frame charts and the bigger picture stuff, and that's what you use for intraday kind of normal trading. So when we talk about Fibonacci, again, we're talking about overextended markets or strong directional moves. Well, I mean, people always ask me, how do you find these things out, Steve? Well, I mean, you look at the charts. I mean, this market's going down, but when do you think you see an overextended move? Well, here, a big red candle, a big green candle, a big red candle, two big red candles. That's pretty much it, to be honest. I mean, it's as simple as that. Something that looks out of the ordinary. You've got lots of little candles. When the markets really pick up and something has happened, that's an overextended move. So what you're saying to yourself is, well, 8% of the time, a move like this will trace to 50%. Well, let me just look at line of sight. That's 50%. Okay, this one actually doesn't work. But this one again, perfect. Yeah, that's easily 50%. So it's an 80% thing. So it doesn't always work, but the majority of times it does work. And that's what you're looking to do. Get something that is consistent, and 80% is a great probability, but also something you can replicate. So if all you're looking for is a big extended candle, and you say, right, well, once I find the low point, and maybe use that with the RSI and Bollinger Bands, you're going to buy it back to the 50% of that move and make some money. Okay? So like I said, this one doesn't work. That's fine. This one does work. You hit a low, the market easily gets back to 50% and above. So out of these three scenarios, you've made money on two of the trades. That's something you can replicate. So 8% of the time, an overextended move will retrace to 50%. Well, I mean, it's just, as I say, it's just simple maths. The market goes down very aggressively. Where's that 50% here? So you don't have to use each individual instance to draw a Fibonacci. You can just say, that's your trade here. So the market moves down, goes back to 50%. Well, that 50% then acts as resistance going forward. So as the market gets back to these upper levels, yeah, you sell back down. So again, you can use previous Fibonacci's and roll them through time, or you can move the Fibonacci's along with the market movement. Again, it's entirely down to you how to use it. I'm just saying that if you pick a right kind of move that is overextended 8% of the time, it will generally work. And that's a good, strong, probability. So I guess the 80% edge is what all we're ever looking for. So the market here goes on to make a new low. We have a fake out here, but the market does exactly what we think. It gets back to 28.3, 38.2, and it gets back to the 50%. So after that, it doesn't matter what it does, to be honest. It can go on and make new highs, it can go on and make new lows. But the fact of the matter is, once it's done that retracement back to the 50%, you've got your edge. You've got your 80% edge. So, I mean, this is why people trade these things in different ways. I mean, you can wait for the market ultimately to find support on 23.6 before getting to 50%, and then you avoid that fake out, or you take some risk on, and you keep buying the low points, knowing that the 80% is likely. So you get to the 23.6, 38.2, much at the 38.2, it's almost inevitable, isn't it, that the market's going to get back to the 50%. But again, it's about being right at the right time. This is the whole point. You might buy here, get stopped out here, then the market does exactly what we think. So again, it's about being right at the right time. And there is nothing I can give you for that, I'm afraid. I can only give you the idea of this 80% Fibonacci type scenario, and then you've got to find a way of interacting with the markets that gives you the edge. At the end of the day, there is no 100% strategy, so 80% is about as close as we can get. So yes, you might get stopped out of these types of trade here and again, but the majority of the time you're going to go on and make good money by buying into this philosophy of the 80% retracement. So again, looking at the H1 and 15-minute view, I mean, this is the hourly view here. So we've seen a strong directional move, so we expect it to retrace to 50%. And if you look on the 15-minute chart, again, you can see all these kind of key levels coming back into play. So the market's hitting the highs, yeah, and it's carrying on what we've known in the past. So again, you're looking for them 50% Fibonacci's to be the key, which are here, and then the market then hits the other Fibonacci levels and goes back down. So if you're looking for an overextended move, which this is, up and down, you're looking for the market to retrace, well, it might take some time, but what's happened in the past will also happen in the future. So you're working between these support and resistance lines, and they're still working, going much, much further into the future. And that, again, is why Fibonacci is powerful, because as long as that move that you've originally done the Fibonacci's on still has some relevance in the market, then the market will still adhere to it in the future. And I guess the kind of second time around, the Fibonacci for me, it's really difficult because once it's achieved that retracement to 50%, doesn't mean that it's not relevant anymore. But you've got to be careful because what's gone up will come down, and it depends how long these things last for. In this particular example, the market goes and makes a strong directional move down. We get to the 50%. Yep, the market tries to fake out, but finds ultimately support, then goes on to make a new high from where you draw the original Fibonacci from. So then you can use things like your Fibonacci expansions and, again, that kind of continuation thing. But for me, really, it's all about figuring out what's happened in the past, using it as a framework for the future, and when it works, great. When it doesn't work, then you look for another instance or another product. That's the whole point. There is no guaranteed thing. There is no guaranteed strategy, and nothing is 100%. So the 80% is about as good as we can get. So when the 50% retracement trade style works, we milk it for all we can. And then when it doesn't work anymore, then we look for a new instance or we look for a new example of how to use these combination of indicators. All right, guys. Any thoughts, any questions, anything you'd like to ask about that? I think if you use a combination of Bollinger Bands to pick your highs, lows, the extremes of the market, and then use a Fibonacci retracement based upon that moves, you're going to start to find better instances within the market of strong moves, highs and lows. Then you can use that 80% rule, that 80% of the time, if you do pick a strong directional move and a significant high and low, then we will get back to that 50%. I mean, just try it on some of the products you trade and, again, see how it works for you. Any questions, guys? Anything you'd like to ask? Any thoughts? Nothing, guys? Nothing to ask? No? Well, like I said, guys, I mean, it's one of these things. It definitely, should be something you should try and investigate. And well, the great thing about Bollinger Bands and Fibonacci is they work on any product, absolutely any product. Doesn't matter if you're trading oil, gold, your euro, dollar, all the indices. It just works on previous movement. Okay, and again, it's all going back to that self-fulfilling nature of technical analysis and things that work time and time again. All right, guys. Well, anything else you want to get me on Twitter at Steve Ruffley or my email address sruffley. All right, guys. Well, anything else you want to get me on Twitter at Steve Ruffley or my email address sruffley@tradermaker.com. Again, using Bollinger Bands is very, very easy because it is a very simple tool to use. It shows you support and resistance, and it again does deviate around a moving average, which is probably the most widely used bit of technical analysis. And then the Fibonacci is an 80% rule, but again, it's figuring out where you use the Fibonacci from, and that's where your Bollinger Bands will help you. All right, guys. Well, it's been a pleasure. Anything else, just do get me on my email or Twitter, and I'll speak to you soon. All right, guys. Have a good night. Thank you.